Hi everyone! Stock markets of Australia, Japan and China are likely to close the week in the red. Asian shares are also down due to a new sell-off on Wall Street and a drop in the US stock futures. All three benchmark stock indices may end September on a pessimistic note. Let's discuss how the Asian session is unfolding on the last trading day of September. Sentiment in global markets is still bearish due to the escalation of geopolitical tensions and the growing risks of a recession. The Fed's monetary policy has a big impact on stocks, especially high-tech companies with mega capitalization. Some internal events or economic data also affect the market sentiment of some countries. Nevertheless, the world's largest economy and the main reserve currency are the driving force on Forex. After the Bank of England intervention this week, the UK government bond yields have been rising for some time. However, today US Treasury resumed growth. The volatility index, also known as the fear-GOG, signals market panic. It surged to a high above 33. The index reflects market expectations for the volatility of the S&P for the next 30 days. When the VIX index rises above 40-45, it means that market fear is growing and investors are getting rid of risky assets. What exactly scared investors and triggered risk aversion? The answer is a batch of recent hawkish remarks from Fed policymakers. President of the San Francisco Fed, Mary Daly, noted yesterday that markets are trying to get to their footing with investors assessing a myriad of risks. President of Cleveland Fed, Loretta Mester, offered an even more aggressive outlook. She said that the Fed must judge the persistence and the scale of inflation. For this reason, she does not see a case for slowing rate hikes right now. President of the St. Louis Fed, James Bullard, expressed a similar opinion. He thinks that the rates will have to remain higher for longer than previously expected. Such hawkish rhetoric has intensified market uncertainty. Usually the greenback climbs following the Fed's hawkish comments. However, it has been rapidly declining for the second day in a row. It has already dipped below its yesterday's highs of 113.28, shortly after it dropped to 111.69 versus its main rivals. Perhaps after a buoyant rally of the past few weeks, the US dollar took a breather. Analysts believe that the main catalyst of its decline was an increase in the pound sterling and the euro. Both currencies advanced considerably amid the Bank of England intervention and the ECB hawkish remarks. On Thursday, the Bank of England intervened in the bond market for the second time to buy long-dated UK government bonds. As a result, the British currency notched its best weekly performance against the US dollar in 2.5 years. In the Asian session, the US dollar slipped into the downward range of 111.58–112.22. The yen has also regained ground thanks to the Bank of Japan intervention. Last week, the regulator decided to buy back the national currency for the first time since 1998, when its exchange rate against the US dollar reached a new 24-year high of 145.90. Yesterday, Minister of Finance Shigeki Suzuki signaled his readiness to conduct another intervention if there are sharp moves. However, today the yen is hovering again near the threshold level despite the relatively weak US dollar. In the Asian session, the dollar-yen pair remained almost unchanged, flirting with the critical level of 145. It was moving in the sideways corridor of 144.18, 144.77. To some extent, the risk of sentiment is also bolstering the yen as a safe haven asset. The dollar-yen pair has already advanced to 144.29. The swing highs and lows are also gradually moving up. Yet a one-time intervention will hardly change the trend. Besides, the difference in the monetary policies of the Fed and the Bank of Japan will continue to adversely affect the yen in the long term. The Australian dollar is also drifting higher of the last trading day of September. This week there was a hit an all-time low of 0.6360 even despite the RBA's upcoming meeting. However, the Australian currency has a high correlation with the US stock market. It is also sensitive to changes in oil prices and, of course, the state of China's economy. Currently, markets are gripped by pessimism and the US stock indices are falling, as well as commodities. It means that the Aussie is lacking positive drivers. For example, iron ore prices in China sank by more than 5% compared to the September high logged 2 weeks ago. Oil prices have been declining since June. Hot weather and lockdowns have pushed China's manufacturing PMI index to a 4-month low. According to fresh reports, manufacturing PMI services indices contracted once again. So a rise in the Australian dollar is mainly associated with a weakening US dollar. Today, the Australian-American dollar pair managed to rebound from 0.6446 and rise to 0.6509. The pair is still trying to break through the resistance level of 0.6500. It means that highs and lows are located higher. The price may reach 0.6600. Even if the pair climbs higher, the main trend will remain bearish. If bears enter the market, the Aussie may retreat to 0.6400 and the low of September 28. Now the pair is trading in the upward channel of 0.6476, 0.6522. That's all for now. The Asian trade is over, but there are more sessions ahead. Stay tuned and keep close tabs on market developments. See you.